Thanks for joining me. It's Stephen Hojo here. In this video, I just want to share with you how I was able to get my credit rating from 0 to an excellent score. Now, I'm going to tell you that this didn't happen in 2 weeks, 6 weeks, or 6 months. This took about an average about 2 years for this to happen. So if you're looking for a video that tries to tell you how you can, improve your credit score within 6 weeks, I'm sorry, that's not the video I'm trying to share with you. Now, when I moved here in 2010, I came with the opinion that for me to actually get something, I needed to have the money saved up. And obviously that is still an opinion that I share till today, and I believe in strongly, because that's actually one of the reasons why I have been able to improve my credit rating. But the steps to get to that point is what I'm going to share with you. I moved here from Nigeria to come study. Now, when I moved here, I didn't really have a lot of information as to how to improve my credit or create a credit score, because there was no one to really tell me that. Now, I'm sure you are probably in the same position where you moved in from a different place where things are done differently. Like in my country, you would have to have your money before you can purchase anything. And if you do not have the money for it, well, you don't get it. The other means to get things, if you have a collateral, or you have a house, or you have an asset that you can put down as a collateral to purchase something you cannot really afford. But since I'm new in the United States, obviously there was no collateral, there was no house to put down, or a car, or anything like that. So no assets per se. So I went to school, and each time I was in school and I had to rent a place or I had to buy something, they would always ask me, do I want to put on a credit? And I didn't really understand, like,
Why would I want to put on a credit? Well, I don't need it. I have the money. I'm going to pay for it and let it be done with.
But I realized over time that it was costing me some more money. So I'm going to give you an example. So let's assume that you want to rent a place. One of the things they will always ask you is, what's your credit score? And at the time, I didn't have any credit rating. So I didn't have any credit score, which meant that for me to actually get a place, I would have to put down more money, like maybe a month or 2 months of worth of rent, for example, before I could rent a place. And I did that for a while. Late 2017 or early 2017 was when I realized that, well, I think this needs to change, because at the time I'd spent about 7 years, and I realized that, well, I could have created a very good rating for myself, a credit score that would be an excellent rating, but because I thought I didn't really need it, I didn't get into it. So at that point in 2017, I realized, well, let me get into this now. So I had to get my first credit card. How did I get that? I had to go to a bank, and I had to have what they call a secured credit card, which is basically a credit card in which you have to put down some money as a deposit or as a collateral, if I put it that way. So you put down some money, and then they issue a credit card based on the amount of money you put down. So for example, in my case, it was about $500, and I was able to get a credit card that had a $500 limit on it. So the idea is that they want to see you repay those amounts as you use it, and then over time you would have a credit report on you, because remember, I came here as a foreigner, there was no credit report on me, so I needed to establish that first. So I did that, and that helped me to establish my credit report or a credit score. And then I was able to then get a credit card, like a regular credit card. I think my first one had about 1,200 limit, and then eventually I was able to get a 3,000 limit, and then a 10,000 limit. And it goes on like that. Now, all these credit cards, I kept them open just because I learned something also. So when I needed to buy a car, I thought, well, I'd saved for the car. I knew the car I wanted. I had a price range of what I was going to spend on the car. And I went on to buy a car. If you haven't seen a video of how to buy a car, a used car especially, because I'm never going to buy a new car, well, at least for now, I'll link up the video as well. You can check it out. So anyway, I went on to buy a used car, and I had the money. But I knew that in order for me to improve my credit, so I thought that I will put it on a loan that I'll finance, and maybe after a month or two, I would pay it off. So I went around and I did that. I got a car, and after about a month or 2 months, just to show that I made payments, I think I held it for about 3 months. Then I transferred the money that I'd saved up over to pay off the car. And I did that. But guess what? It really hurt me. My credit score went down from about 700 down to about 6 something. And I was shocked. Why? I mean, I paid off the account. I didn't know that would actually hurt. So that's something that you need to keep in mind. If you're planning to buy something, do not pay it off too quickly. Let me put it that way. Because when you do that too quickly, you would end up hurting your credit score. So anyway, my credit score went down back to about 6 something. And then, but I didn't care because, to be honest, I wasn't really out there trying to shop around and get more credit cards or things like that. So I didn't really care about it because I knew over time it's going to go back up. So, which was just left it where it was, and I just kept making my payments as necessary. But this is where this could have hurt me. Let's assume that I wanted to buy a house in the next 6 months or a year from the time I paid off that car. Then guess what? My credit score would have been very low, which meant for me to buy that house, my interest rates would have been very high. That means I would have actually paid more to borrow money. So it would have worked against me. So that's something you need to keep in mind, and that's why I'm sharing this video with you. The best thing you can always do to avoid this is to use a revolving credit card. Like, for example, if you want to just build your credit, the best thing you can do is just use a credit card. Have different type of credit cards, not too much, but at the same time, maybe 2 to 3, preferably 3, to be honest, or more. But again, you don't need a lot of it, but at least you need a handful to show that you are making payments from different sources. And that's the key thing, because the more these financial institutions report on you, the better it helps to increase your credit score. Now, the other thing that also helps is if you have different type of loans. For example, if you have a car loan, you have a credit card loan, you have a school loan, you have a mortgage. The more you make payments on these different loans, the more reports you have, and the better it shows that you can manage your loans, pretty much. And that's what your credit is. And for you to get more loans, you have to show that you've been truthful to your words, if that makes sense. I paid off the car, my credit score went down, and then I was able to then just focus on just making payments consistently on my credit card. So I'll try to use my credit card, like buy gas. If it was a travel related credit, I'll put it on a travel related credit card. And I did that on different sources, and I was able to get my credit score back up to about 720, I think 730. And it stayed there for a little bit and just didn't really see much movement. Sometimes go 1 point up, 1 point up. And I was wondering what was going on. So I opened up a mortgage loan, and after about 3 to 4 months, and that was when my credit actually went to about 780. Now, all this took an average of about 2 years and 6 months to build. Now, imagine I've kept this going for the past, 7 to 8 years. I'm sure my credit score will be in the 800 range. But that's not something to regret about, because I don't really care if it's 800. I don't really care if it's 600. I don't care if it's 500. Why? Because I do not buy things I couldn't afford or I couldn't have paid for in the first place. I always make sure I buy things that I can pay off almost right away. The only thing that obviously in this age is like a mortgage, because it's quite a lot of money, and at the same time it just doesn't really make a lot of sense to pay it off right away, or at least to save up for like 20 years just so you can buy a place, So there's a bit of a balance in that. But when it comes to like a credit card or buying a car, my advice is that try to save up a significant amount of money, especially if you find something that is expensive, and try to pay it off as soon as you can. But like I said, make sure you plan how you pay it off. For example, if you're paying off a car, don't just pay it off right away, because that would hurt you if you put it on a loan. You're almost better off just saving the money in cash, wire the money to the dealer that you bought the car from, and just end the transaction that way. But if you're trying to improve your credit score, do not pay it off right away. Let it go for about at least 6 to 1 year paying that car, because that would show consistency. But what you can do is that you can increase your payment. So let's assume that you're supposed to be paying $200 on your car every month, and you want to pay it off pretty quickly, even though you have the money saved up. But because you want to improve your credit, you can actually just pay, maybe 400 or 600 every month, because that way you won't pay it off right away, and at the same time you're able to get that report on you showing that you're paying your loan, and that is what you really need. But the mistake I made was I paid it off after about 3 months, and that really hurt my credit. Like I said, it dropped almost 30, almost 40 points, and I was really shocked. But at the same time, I wasn't really concerned, because I knew that I didn't really need a high credit score to do anything, because like I said, I'm a fan of Dave Ramsey and I believe in the teachings, but at the same time, I had a lot of issues knowing that I didn't have anybody to support me when I first moved here, and I wish I had just learned this earlier, because that would have saved me a lot of money that I was just paying to these people upfront for no reason. And that is why I want you to learn this early as well, so that you can make use of this opportunity that is available to you. But one thing to be careful about is credit cards can put you in a very bad situation because they have very high interest rates. The average credit card has about 20%, all right? And if your credit score is even worse, you're going up to 25 and above interest rates on your credit card. And immediately you have a lot of balance on your credit card during the month or during the course of time. This racks up quickly. And that is why you do not want to carry balances. I do not carry balances on my credit card for this reason. Before I put any money on my credit card, I pay it off within a day or two and just make sure it's zeroed out because I do not want that balance to carry over. Well, that's all I wanted to share with you guys, all right? If you have found some value in this video, please give this video a thumbs up, share this video with someone that might benefit from it, and at the same time, leave your thoughts in the comment section below. Let me know what you think. If there's something you have done that has helped you in the past to improve your credit score or the mistakes you made, please share in the comment section below because this would help everyone to learn from this video, and at the same time it's going to help this video perform so that it can reach more people. But one other thing, if you haven't subscribed to my channel, please consider subscribing to my channel, and I will be seeing you in my next videos. Have a great day.